Short-term confidence is up. That's the market rebound and the trade talk. If trade deals don't get done, or if this spending bill adds to our deficit and yields keep ripping higher, that's going to crush consumer confidence in the long run. And it's also going to crush one of the most critical components of our economy, Chip, the housing sector. And if the housing sector is not doing well, the economy is probably not doing well.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, we'll get to the news eventually, but you were in Chicago recently, and literally you were making some noise. Tell the folks about it.
Yeah, I had the honor of ringing the closing bell at the Chicago Board of Options Exchange. So this is where all the options trade on what's called SPX around the globe. It's also where the VIX, the Volatility Index options, trade in two giant pits right next to each other, and that was quite the experience. We were there actually launching an ETF. So on this exchange is where a lot of exchange-traded funds trade. Ironically, at this very building, going back to 1999, I traded on that floor when they actually had the futures trading right on that floor. That has just moved down the street in Chicago. But basically, I started my career. I was a commodities trader for a short period. And for just 2 days, Payne Weber, my old employer, sent me up there, and I got to actually work the floor. And if you've never seen the movie Trading Spaces, Trading Places, my wife's HGTV show. Sorry, I'm throwing wrong reference. But with Dan Aykroyd and Eddie Murphy, it's a classic where that was on the NYMEX exchange in New York, but they were trading OJ futures. And that's what it was like literally back in the day. Everything was hand signals. So E.F. Hutton is trying to buy from Merrill Lynch. I went 3,000 shares, right? And you would signal half, quarter, and we traded in fractions by hand signals, right? And I try to get the young people, what do you mean fractions? They couldn't even do the math, you know? And so it was a lot of fun. But anyway, being back on that floor afterwards was quite the experience. Now, I'll tell you, what was really cool is we were there, we got to talk with a lot of people in the exchange for about 2 hours prior to closing. And then the official who was there to give us the tour, he goes, we have to finish the tour before you're allowed to ring the bell. In the basement is the trader's bar, and they require you to have a trader's pour. So anyway, I happened to just name a favorite. Yes, and I mean it was a trader's pour, and it was pretty exciting. And then you go up there, and they warn you when you're about to ring this bell. It's a physical bell, and he's like, it's going to be louder than you expect. And oh my gosh, I still was not prepared. I didn't hear anything for about 6 minutes after actually ringing the bell. And the funny thing is, the traders on the floor actually bet on how many times you ring the bell. And they kind of tell you have to ring it at least 3 times. You cannot go more than 25. But they bet, and there's 2 ringers. So me and another gentleman, Sean, got the honor. And so I had a number in mind, and they have an over-under. So I had to ask them, hey, before you go, I need to know how many. And we literally did rock, paper, scissors right before we walked on stage to see who got to go first. So I just said, just tell me your number so I know when to grab the rope. And you literally physically grab the rope. But anyway, really fun experience. And we were helping launching an ETF called OneZ, ONEZ is the ticker. It's a buffered ETF, and the reason this is, the symbolic of launching on the exchange, that is where how buffered, which is one of our more popular portfolios, we're able to use options to reduce risk in a portfolio. And where are those options traded that reduce all that risk? Right there in that pit that you just saw a picture of if you're watching on YouTube. So anyway, quite the experience. I look forward to maybe taking some of the advisors back in the future. We may get that opportunity again next year.
Radio listeners, you may want to find us on YouTube for this one. One, to see video of David actually ringing the bell at the options exchange. Also, to see a quick round of charades here when he was doing E.F. Hutton. He's holding his ear. I'm old enough. I remember the commercials. When E.F. Hutton talks, people listen. And then he's got 2 horns coming out of his forehead doing Merrill Lynch. So you've got that added feature as well if you look us up on YouTube this week. All right. Into the news we go, David. President Trump is getting some pushback on the right to the so-called big, beautiful bill. It did get through the House. The tug-of-war is on now in the Senate. And this is a headline from The Hill, a publication on Capitol Hill. GOP senators say Trump's big, beautiful bill needs spending cuts. These are people, Rand Paul, Ron Johnson, who are proven Trump allies. But, David, right before we sat down to do this show, we were talking about the fact that in his first term as president, Trump had many successes, but fiscal reform was not one of them.
No, and I've talked about that. He's a populist president. I talked about it. I voted for him. Don't agree with all the things that he does or says, but I think of the choices, he was the correct choice this last cycle as well, based on what we need to have happen. And he's had some significant wins. The border was one of the things I talked about. The border and debt were my two big issues, right? Well, we got one covered. The other one, not so much. And that's where everybody was excited about Doge. And this was a 74%, I believe, in the most recent poll, popularity of everybody, doesn't matter political affiliation, thinks we need to be fiscally responsible with our spending. Now, some would argue which cuts should happen and shouldn't happen, and that's going to be a personal preference. And I get it. If you're receiving benefits, you don't want them cut, et cetera. And even my own nephew. So my nephew lives in South Carolina. He is in the solar industry. This bill guts the tax credits that he gets to give to clients or customers, and literally will probably shut his business down by the second half of next year if it goes through in its current form. And he literally had that phone call me yesterday. I voted for him. I really like the guy, but how do I reconcile this in my head? I'm like, well, if your product isn't good enough to sell without a tax credit, is your product really good enough?
Yeah.
And so, that's the thing. But again, you can't try to pick winners and losers or industries, and that's what Republicans and Democrats alike have done for years, and that's why we're in this fiscal crisis. And now with our downgrade, so we've been downgraded by all three major rating agencies, U.S. debt, $36.5 trillion in debt and skyrocketing. And this bill, in its current form, doesn't really cut anything until year 6. And of course, legislative and presidential elections happen between now and then. So we don't know if that would ever stick. And so they're trying to say, oh, we're going to extend the tax cuts permanently. That's not going to happen. You're not going to get 60 votes in the Senate. So it would be reconciliation, which would limit that tax cut to 10 years. But that's going to add about $4 trillion into the debt. That's not helping. Yet Doge came through and showed us between 250 and 300 billion a year in savings. But nobody's actually implementing any of these projects, right? They showed where it is. And so that's where now, because the public pushed back ugly, this was voted on, and this bill got significantly changed. They mark them up. Between 11 p.m. and 6 a.m., they pulled an all-nighter. They destroyed this bill from what it was a much prettier bill, in my humble opinion, just 7 hours before they voted it through. But they passed it with one vote, right? And again, I know they felt they had to do something. That is politics. You got to give and take. But I'm sorry, the American public, and we're saying no thank you. I'm sorry, not good enough. Go back to the drawing board.
Well, you mentioned Doge twice, and here's a CNBC headline. Elon Musk says Trump's spending bill undermines the work Doge has been doing. Do you see it the same way?
Absolutely. I mean, you've got to show us you're willing to make some hard decisions. And again, we're going to be talking in the next segment with Sean Swanson, who teaches our Social Security class, right? When the advisors, and like Social Security is so easy to solve, Chip. It's just so easy. But again, nobody wants to have to go back and face media because they want to get reelected. And the problem in the House is, as you know, you're in election cycle. Literally 30 days after you get elected, you fire back up the campaign.
Oh, it's nonstop for a House member.
Yeah, you
There's
have
always
no
another
choice.
election around the corner.
And so why not put term limits where these guys can only serve, say, 3 terms, so they can serve a total of 6 years, and out the door they go. They want to go run for the Senate, fine. Senators serve 2 terms, 12 years total, out the door you go. And again, why don't we actually fix things and make senators get appointed by the state legislature? Then you might pay attention to your state legislature ballots, because that's the way it was intended. And again, most people don't know that. I'm going to go off on a history rant here, but yes.
Going constitutional on us.
So at least some senators, for political cover, are sounding the alarm before they start to mark up the bill. Now, do they hold the line and actually trim some spending? I'm hopeful, but we'll wait and see.
Well, Musk had an interesting quote. I think a bill can be big or it could be beautiful, but I don't know if it could be both. So we're seeing that play out. All right, let me shift gears with you, David. In the time we have left in this first segment, tariffs and trade. Here's a Fox Business headline. EU, that of course is the European Union. EU agrees to fast-track U.S. trade talks after weekend Trump call. I believe that sparked a market rally. Are we seeing more of the payoff, the dividend from the tough tariff talk up front?
So again, no deal has actually been signed with anybody, right? And so that is the discounting part. And it's Trump, tax on, tax off, right? It's like the Karate Kid of tariffs here, President Trump. And there's actually memes going around with that. But so he kind of put out last week, 50% tariff starting June 1st on the EU, right? And that sent the markets down last week. And then on Sunday, tweeted out, we just had a call with the EU. We're going to kick that out to July 9th. That's an odd date, right? So July 9th. So he basically bought about 6 weeks. So the futures markets, which do trade on Sunday evening, even when the markets are closed here for Memorial Day on Monday, were up pretty big. And then Tuesday, the market opened, had a nice rally all day long. The Dow was up 600 or so points. But we rolled into Wednesday, which is the day you and I are recording this, and the markets are kind of just stalling here like, Now, there's a big event today. As we're recording this on Wednesday, by the time you hear this show, NVIDIA will report earnings this evening. So this will have happened before we air this show. I don't know the result of that. But that's a pretty big, important instrument. So I can't tell you what's going to happen there, but if NVIDIA has any kind of slowdown or any hiccups in their earnings, we could see this market fade rather quickly. If they have stellar earnings and stellar growth, then it could hold the line here. But the markets are just a few percentage points from their all-time highs. Historically speaking, after setting all-time highs like we did, we traded sideways for about 4 months. We went down pretty hard, over 20%. Now we back up. We're probably going to have to trade sideways for a little while before we can really make a big move forward. We'll wait and see.
Up next, we have another round of Social Security classes coming up. That means it's time to check in with financial advisor Sean Swanson. He's up next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Smart Social Security Blueprint is one of our most popular classes. With us today is our resident authority on Social Security who teaches that class. David, please welcome our special guest, financial advisor Sean Swanson.
Thank you, Chip. Once again in the studio, we have our resident authority on all things Social Security. And of course, we have a class coming up on these very topics called Social Security Blueprint. So, Sean, thank you for stopping by the studio.
My pleasure.
So, listen, this has been a fun week. We've had a lot of fun around here. We are transitioning into real summer. So I think this nice, cool May we experienced, unfortunately, is going in the rearview mirror now. And we're going to experience some real heat. Sometimes that heat causes pain for people. But what causes a lot more pain is when people make a bad decision on Social Security because you can't undo it, right?
This is true. And in fact, I thought I would turn the tables on you, my friend. So today, what I thought we would do is we, through the years, have collected the top questions that we receive on Social Security. Now, don't give away the farm. Don't give all the content, all right?
All right.
But here's just a couple of questions that we get, and then I know that we're going to cover in the Smart Social Security Blueprint classes, which are coming up this upcoming Tuesday and Thursday. So it's Tuesday, June 3rd or Thursday, June 5th, beginning at 6:30 p.m. in the Midwest Learning Center. And classes actually do fill up very quickly. So I want to encourage the listeners to jump on that and register by calling 402-369-7777 or going on our website, retiresmartnow.com. The number one question, David, you know it. Here it comes. David, will Social Security be there when I get there?
You know, people always get nervous. Hey, it's going to run out of money, etc. Well, in reality, for that to happen, our country has to literally be defunct. There is zero political will. Republicans, Democrats, Independents, Green Party, any politician that unfortunately is not going to be term limited wants to do one thing, get reelected. Mm-hmm. And what they don't want to do is take away a benefit or an entitlement, if you want to call it that, from the biggest voting bloc in American history, baby boomers, those that are typically the most concerned. So as I taught you many years ago, the political hacks, if you will, on both sides of the aisle like to use these talking points and fear,
yes, they do,
to scare constituents to vote one way or the other by promising more benefits, saving benefits, et cetera. But they never actually get into the actuarial math. And again, I could solve Social Security in literally 3 minutes, but I'm not going to give that away today, but that'll be another video. But I like to describe it, and you've done a great job of taking that. And I kind of like picture a barbell, right? A big weightlifter's got a huge rack of weights on there on each side and a long bar in between, where you kind of describe the size of generations. Because baby boomers, which are the generation just ahead of you and I are just in the next generation called Gen X, we're less than half the size of the boomer generation. And people don't understand it. That's significant. So that means in just a few years, in just 5 years, we'll have dropped from 14,000 people drawing Social Security a day to under 4,500 a day on average going onto the system. That is a lot of relief coming just around the corner. But yeah, we do have some fiscal problems to fix in the meantime. But anyway, so I would tell you, if you're scared of Social Security being discounted, now that's a real possibility. But if you're scared of it ever going away, you really need to attend this class and watch Sean explain what we call the barbell theory so you can understand and have confidence that your benefit will be there. Will there be changes to it? Probably so, if we have any politicians with any kahunas, so to speak, to make some structural changes. But I don't think there's a dollar going away from anybody over the age of 55 today.
Yes, and that barbell talk is one of my favorite because it's very eye-opening. I noticed that people in the class are definitely taking notes as we talk about that. The second question, David, again, you've heard this a million times in your long career. When should I take Social Security? So we know we cover the basics, obviously, that the earliest you can take it is 62, the latest you can take it at 70. But how many combinations are there?
I believe the last I counted, if you're a married couple, over 536 different combinations, et cetera. So can be a little intimidating. And the odds that you select the exact month and date to turn on, if you're married, both Social Securities and get the maximum benefit by your death, the odds, there was a statistician that did it. It's less than 1/10 of 1%. You'll pick it.
Yeah, to get it right. So the whole Social Security planning decision, we don't leave that to chance. It's another thing that we talk about in the workshop. And one of the benefits of coming to the workshop, David, you made available to everybody that comes a free Social Security maximization report. And so I have a couple of pictures of that in the seminar. I'll walk people through that. That's you're graciously offering that to anybody that comes to it. We can, as long as we have what I call their blue bar report, it just takes me about 3 minutes to enter in that data and give them a very powerful report.
And it's eye-opening for a lot of people. At least they have more okay, now I understand. Because many people don't even know. They've never logged into the, and by the way, if you've never logged in, ssa.gov, right? Log in, create an account, establish your account, because you may also, sadly find errors. I had an error in my Social Security reporting, so it shows you your earning history every year you filed a tax return in the U.S., so you can go all the way back. The other thing I think it's really important is to show the power of inflation. I often like to just flip that over and show them their earnings history, because when they tell me that, oh, I won't need, they tell me I can live on $40,000 a year, and
Good point.
They're making 120 now, and I'm like, no, you're not going to be able to live on 40. And so I go back and show them what they were earning, in 1987 on their earnings report, and I'm like, hey, you made $18,000, and you felt good about it that year, right?
Yep.
The reality is you're going to need more money because of inflationary pressures, and that's a great way to visually show people what they earned through their working career and how inflation rose their wages over time. But anyway, just a helpful point when you're coming to the income planning portion of a smart plan.
Yep, and just for time purposes, I'm going to skip ahead. You taught me a great example that you've done more than once in your career. How can I increase my Social Security? And what I'm getting at is that wonderful example that you taught me of a business owner that was taking income the wrong way. What did you recommend to him to actually pump up the volume on his Social Security, David?
Well, there's a couple of ways to help entrepreneurs, business owners that are in control of their own paycheck, so to speak, potentially save on taxes and or increase Social Security, in particular if they have a spouse and that spouse is also an employee of said company. So I did. We had a physician, and his wife ran the practice, was the office manager. He was the physician, but he was 6 years older, and he was being paid a healthy wage beyond the Social Security max. So he maxed out how much he has to pay in Social Security, but he's not adding. And then he got to full retirement age, which is 67. His wife was actually just turning 60, so she still had 7 years of runway on her earnings history. So he simply had them flip who got paid how much money. Now, it's increased her compensation to the Social Security limit and decreased his compensation because he was not adding, even though he was paying payroll taxes, he was not going to add 1 penny of additional benefit. That's the way the system works. And if you don't know this, this is why I always say you don't know what you don't know. So by flipping the switch, we got them an estimated additional $40,000 over their lifetime in Social Security benefits from the exact same tax bill they were paying.
That's significant. And that's the reason why, our strong suggestion is that you'd work with a team that does this every day.
And it takes a team, right? Yeah. You are literally our authority in-house here on Social Security. But then we have estate planning. We have Mike Schutel, the advisor, sits in the conference room next to you. Then we have to talk about, charitable giving, plan giving. We have Jacob Oren, financial advisor, one conference room over. Digital assets. We talked to Brad Starkett. We've got a hall full of highly qualified, licensed fiduciary-based advisors that all specialize in one topic or another to bring that cohesiveness and that team approach to help people get the best solution possible. And then my forte and that specialty is the tax planning, which is really critically important when it comes to Social Security planning, because not only do we want to maximize it, we want to optimize it. And that sometimes Social Security making the wrong decision can be a $50,000 taxable mistake because you don't understand how you're taxed on Social Security, which you cover in the class, right?
I love it. No, we have a running joke among the advisors that are blessed to work here that our job is to translate into English what you've taught us. You talk really fast. I love that about you.
That's weird.
I slow down and I use the whiteboard a lot to draw simple pictures and make sure that clients understand everything that we're doing. Do we have time for one quick one more?
Yeah, let's fire one more. Why not?
Quick one. Can my non-working spouse qualify for any Social Security, Mr. Brooks?
Absolutely, but there is a couple of criteria. So first off, if you've been married to that non-working spouse for 10 years, they will qualify for what's called a spousal benefit. But let's say it's late, and so they're going to get basically half of your full retirement age benefit, or if you took Social Security early, there's a discount to that, can be as great as 40%. So,
ouch.
So again, don't just make this decision. But yes, you can qualify if you've been married with a longevity kicker in there. There is another way, and a lot of people are surprised about this, Sean, is we have a lot of folks, my parents are included in that were remarried, right? Some of them multiple times. First off, there's a difference between before 60 and after 60 decisions for divorcees,
yes, there
right, and widowers. I'm not going to get into that today. It's too complex. But a lot of people don't know that if you had a late in life marriage and the survivor maybe didn't have Social Security or had a very small benefit. For instance, my mom only has about a $400 benefit. She lived outside the country for many years and didn't earn anything. So I'm literally constantly trying to talk my parents into getting remarried 54 years later.
Yeah.
But because my dad has almost a $3,000 Social Security benefit, and if they were married for just 1 year, Sean, and my dad were to pass away, she would keep the larger check. Only need to be married for 12 consecutive months for that to apply. And most people don't know that exists.
Yeah.
So again, you don't know what you don't know. If you're curious about Social Security, if you're anywhere within 3 to 5 years of drawing Social Security, I highly, highly encourage you to come to this class if you've not attended. When is this going to be, Sean?
Once again, yes, it's coming up this next week, Tuesday, June 3rd or Thursday, June 5th, 6:30 p.m., the Midwest Learning Center right here on our campus. You can call 402-369-7777 to register or go on our website, retiresmartnow.com. We'd love to see you there.
All right, Chip, what do we have next?
You have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go, David. The first question is about a tax-free retirement. Someone who went to one of your presentations said you mentioned the possibility of driving a client's tax burden down to zero in retirement. Is that something you throw out as bait at an event, or is that something you actually have done?
So that's a great question. And the answer is yes. We have actually done it on multiple occasions. About 40% of the prospective clients that come to see us have the possibility of getting to a 0% tax burden. Now, this is not going to happen overnight. This typically takes 6 to 8 years. And again, that's a rough estimate by my calculations. I don't have a stat sheet to give you here, so I'm going to give full disclosure there. But yes, you need to understand how your income will be taxed in retirement. And to get you to a 0% tax liability, we need to have only tax-free instruments coming your way for income. So I'll give you an example. Social Security, we just had Sean talk about it. And we actually talk about the taxation of Social Security at the class that he'll be teaching. Well, Social Security is not necessarily needed to be taxed. It's only taxed if you have other sources of taxable income. So what do I mean by that? Well, it's a calculation where we take half your Social Security plus any other income you receive plus half of your tax-free interest. So be careful there. That tax-free interest is no longer taxable. And we add these numbers up and we create and if that total income is over a threshold, $32,000 or $44,000, you could have 50% or 85% of your Social Security tax. But if you have no such taxable income, Chip, you could get your Social Security 100% tax-free and then take withdrawals from certain types of retirement accounts like a 7702 specifically designed a special life insurance policy, or a Roth 401k, or a Roth IRA.
I was waiting for the word Roth to come up. I figured that
there's
must
a
be
multitude
in the
of
formula
things that
somewhere.
you can receive income that would be tax-free, and would not only is it tax-free, it does not require additional tax penalties on things like Medicare. So you can literally, we designed one client who's going to have over $250,000 in income in retirementship, 100% tax-free. Again, can't do it for everybody, and not everybody gets there, but possibility, yes. About 4 out of 10 folks we talk to, the possibility is there with enough time and planning. But you have to start as early as you can. So yes, it's absolutely possible.
But certain windows close at certain times, so you've got to be proactive and get the ball rolling.
Yeah, and even if you start late, we can get you there, but there may be a little what we call short-term pain for long-term gain to get through that. And again, it depends on some people. It's not appropriate to take them to 0% tax liability, simply because they actually want to, they're more, legacy is more important. They would like to see more dollars pass to their kids, potentially tax-free. And again, we can steer the ship any way you want, but until you understand the tax code, it's very critical that you design what I always call the buckets of money, right? There's 3 kinds of buckets of money when it comes to the IRS. So we want to make sure we're putting money in the right bucket at the right time, and then pulling money from the right bucket at the right time, which is even more important.
But the point is, it's not just bait.
I've done it for over 100 clients, yes.
All right. Next question, David, is about investment in retirement. I understand investing in the markets while growing my nest egg, but once I retire, should I get out of the markets? Isn't that the best way to keep my assets safe?
Well, safe from market fluctuations, maybe, but safe from you running out of money, not necessarily. And what do I mean by that? So in the previous segment, again, we had Sean Swanson, and we were talking about looking at your Social Security history as a great way to help you understand the power of inflation, how your wages have gone up, but they've needed to. You've never felt really that much richer when you look back and see how little you earned 30 years ago on your Social Security sheet. So we have to inflation adjust your income plan in retirement, and Social Security will not, unfortunately, keep up with most people's real household expenditures when it comes to that. So most people need to have a portion of their assets still invested in appreciating assets like the markets. Now, we would like to show you how to diversify into multiple asset classes to get growth on those dollars, but the safety part should be any money that you need in the near term. And some people are really risk adverse, so we might push that up. And again, we want to build a plan that's tailored to the individual. So, but for most people, we're going to suggest at least a portion of their assets take on things like market risk, because over a long period of time, they're going to get a higher rate of return, at least historically speaking, and that's going to help us keep up with the pace of inflation.
This is one of the biggest mindset changes I have made since coming to work here almost 5 years ago, is that you think of retirement. I got to cross the finish line. Well, it's a finish line perhaps in terms of your working life, but it's a transition to a new stage of life that could well go 20 or 30 years.
Oh, very, very easy over 30 years for a lot of folks today.
A static pile of money will disappear over time.
Very quickly,
have to think about growth even in retirement.
Well, I mean, I think it's awesome. Just since you and I met, oh gosh, almost 8 years ago, whatever it's been. But yeah, you've been on board for 5 or
yeah.
I'm like, how long have you been here?
Right.
But exactly how much information you have learned. And I mean, you've got a law degree. You're a pretty smart fella. You worked in the legislature, city councils, but how much information you have learned.
I should get 3 credit hours at least,
because there's so many factors into a true holistic financial plan that cover all these areas. Yeah. How does Medicare affect your income plan? How does Social Security affect your taxation plan? How does risk management and taxation work together? All of these things have to work together if you really want to maximize the efficiency of your assets and the resources you've worked your whole life for. So do not tread lightly here.
Let's see if we can squeeze one more in, David. This is on 401ks. I saw an article that said by age 67, your 401k should be 10 times larger than your annual salary. So if you make $70,000 per year, you should have $700,000 in your 401k. Is that a benchmark you use at Retire Smart?
So we don't necessarily use a benchmark like that. However, I always tell people, you're gonna basically want at least 10 times your ask, if you will, is a safe way to look at it, depending on what age you retire. So if you retire in your early 60s, You might want to say 12 times. And these are just round numbers. And again, depends on what sources of guaranteed income you have. So there's a lot that goes into this. It's not really just this cookie cutter answer. So if you don't have any guaranteed income, if the only guaranteed income you're going to have is, say, Social Security, and you're married, you're going to have those two checks coming. What is the gap between those two deposits you're getting every month in your bank account and what you need to survive? And let's just say someone can live on $5,000 a month, right? 60 grand a year, and their Social Security is $3,000. So they have a $2,000 gap, $24,000 a year. But the problem is that gap, we just talked about inflation, $24,000 won't cut it next year. 10 years from now, that $24,000 is going to have to be more like $38,000, right? So we have to have an income plan design where we can increase where we're pulling dollars down from. The bigger the pool of money you have, the easier that is to design. But how long you want to be retired? You think you're going to be retired? Life expectancy, age, you're going to retire. So there's a lot to figure out. There's a great book that I used to give out to, it's called The Millionaire Next Door. And it just has some great benchmarks in there. So basically what you should have saved at age 30, age 50, age 60, et cetera. So it's not a bad benchmark to struggle for, but it doesn't necessarily mean that has to be you, because if you're blessed to have like a pension, you might not need as much money.
Up next, job numbers have been better than expected the last 2 months, yet Manpower is cutting its dividend. We'll tell you why next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, I do want to get to what's going on with the Manpower Group, but first, you alerted the team to this CNBC headline, Consumer Confidence for May was much stronger than expected on optimism for trade deals. We referenced the Consumer Confidence Index numerous times over the course of a year. Do you think, is the index reflecting reality here?
Well, it does, because it confidence is up, you'll spend more money, right? And our economy is consumer driven. So, and why is it up? Well, even though the stock market is not the economy, right? When the stock market rebounds like it did, confidence exudes around, right? Your 401k balance went back up. You were a little nervous maybe a month ago. We had people in questionnaires, right?
True.
When it rebounds like it did, a quick rebound, all of a sudden people get confident. And of course, there's been talk of trade deals, lots of talk of trade deals. We don't really have deals, but that optimism is what refueled the rebound in the markets. And then, so that also is playing out in consumer confidence. So yes, consumer confidence is up. And that means, and just so you understand, that means the next 4 to 6 weeks, consumers will continue to spend as they have spent. So that's a good sign in the short term. Softening job market would take us potentially the other way, and that's the Manpower story that you had mentioned earlier that we were talking about. So,
well, let's go there next. And you alerted the team to this. Manpower Group just cut dividend by 53%. When the world's largest staffing firm is pulling back cash, you should probably pay attention. You've got other stats and observations here. What's going on here? As I said, well, the job numbers have been great the last couple of months. Why is Manpower so nervous?
So they're basically about the largest staffing company out there. So, right. Staffing companies are helpful for companies that are growing and you can't quite hire fast enough. And so you reach out to a staffing company, they can find you temporary employment, and many of these jobs become temporary. We've hired people from staffing companies that we roll them into full-time employment after our contract with the staffing company is up. So they help place potential candidates into jobs, et cetera. They charge a margin on the wage you are paying the person, so that's how they make money. Well, they are forecasting pretty rough times ahead. They cut their dividend in half, and I mean that is not an insignificant move, and that's telling you they see significantly less revenue in the near term or coming 6 to 18 months or so. So as we've been talking about, we see a softening, a very, very aggressive softening in the job market. We've not gotten into net job losses yet, right? We still are creating jobs, but those numbers, I mean, just a month ago, we had 127,000 jobs created for the month. That was a pretty low number. As we've talked about for years, you want to stay at 250,000 or above to keep the economy growing, and that takes care of birth debt rates, et cetera, but we are not doing that. And of course, we had all the information come out from the government. Oh, those 800,000 jobs during the previous administration, we made those up, right? So the job market is nowhere near as strong as it was kind of touted, and that's a leading indicator of where the economy is going, because if people lose their jobs, and we're seeing that pick up, as I said, you're not going to see job losses really mount until the back half of this year. because the higher interest rates and yields have been spiking. That's higher cost of capital for corporations, which means they can't borrow money to expand, which means they aren't going to be hiring new employees, et cetera, et cetera. And it just rolls. So again, short-term confidence is up. That's the market rebound and the trade talk. If trade deals don't get done, or if this spending bill adds to our deficit and yields keep ripping higher, that's going to crush consumer confidence in the long run. And it's also going to crush one of the most critical components of our economy, Chip, the housing sector. And if the housing sector is not doing well, the economy is probably not doing well.
Well, we have something on that too coming up. Boy, the laws of economics, they're just as binding as the physical
so weird
laws.
how you
just like the law of gravity in the physical world.
Breadcrumbs, right? Yeah, but we have editorializing people on the news. We don't have people that actually do fact checking anymore and actually just tell you what's going on. So hopefully you find this show is a nice place to find some of this information.
David, you mentioned that, let's see, how did you phrase it? Confidence fuels consumerism. Confidence, people buy if they're feeling good and they're feeling confident about where the market's going, where the country's going economically and financially. Well, now, you almost have to be a psychologist to be an economist these days. You sent the team some information on delinquency versus consumption. We are a consumption-driven economy. And what stood out to you?
Well, we have a lot of folks that are falling behind on their bills. So auto loans are at serious delinquency rates. We're now seeing subprime mortgage borrowers at very, very high serious delinquency rates, credit card delinquency rates. So all the factors, right? Mortgage debt, that's the one that you really want to pay attention to, because most people, they may not pay a credit card bill in the short run. They get in trouble and then go a couple of months and try and catch back up. But you pay your housing, right? This is where you live. You do not, the fear of foreclosure is a very real motivator. So people typically will pay that bill first and foremost before any other. And we're starting to see delinquencies in mortgages start to creep up. And again, it makes a lot of sense. People bought houses that were maybe a little out of their reach under at least traditional metrics, Chip, over the last couple of years. We saw housing take off, right? But now interest rates have creeped up. So if you bought your house, and about half the mortgages are over 4% now that are out there, and so, which is really normalized rates, but that's a little bit higher. And people thought, well, I'll just go and pull the trigger now because I'll refinance in a year when rates go down. Well, rates didn't go down. So now they're paying that interest, and all of a sudden now their tax assessment, because the property assessed higher, they have a much bigger tax bill. Oh, and by the way, homeowners insurance in the last 5 years has gone up over 53% nationwide average, right? And your auto insurance goes. So all these bills are rolling up, but your wages aren't keeping up with that. In fact, we're starting to see wage inflation really roll the other way. So all these point to, all right, at some point the consumer is going to say, no mas, I can't do anymore. On top of that, I only have the story this week, student loan defaults are now being reported to the credit agencies again. So all these people that had these forbearances for the last 4 years and weren't paying a dime, well, now you're going to get dinged on your credit report for it, and therefore it's going to make you have to pay even higher interest rate for anything you do try to finance or refinance. Not good news.
It gives me the 2008 shivers when I see data like this. And
when you look at certain parts of the housing market, that's very true. So
right,
I sent you a listing in Florida, right?
Help me out, David. The protagonist in The Big Short, in the movie, I can't remember his name.
Steve Carell played him, but yeah.
Steve Carell played him. I can see Steve Carell in my mind's eye, but I can't remember the guy's name. Real feisty, cantankerous guy, wasn't accepting conventional wisdom. Didn't he go down to Florida and start actually knocking on doors and checking on the housing market in Florida? And what he saw, the collapse beginning to happen in Florida, wasn't that kind of ground zero for what became the 2008 crisis?
Yeah, we saw pockets in Florida had a very, very, very big retraction in prices. Phoenix, Arizona, and parts of California had really significant drawdowns. So in other words, now we've seen during the pandemic, people move to the southern states a lot, right? Better weather, et cetera. And in particular, some of the tax-free states, right? And liberty states, if you will. So we had Texas, Florida, Tennessee, South Carolina, and Arizona. People moved to those states at very aggressive rates over the last 5 to 6 years. Well, that creates a demand, right, for the housing. So the housing prices just kept going up, and people had all the stimulus money so they could pay it. And interest rates were artificially low. So, all right, even though it's 50 grand more than I thought I'd spend on a house, the mortgage is cheap. So they bought these houses. Well, now, just what I talked about, finding out what it costs to maintain that house, the housing insurance, the taxes, et cetera, the maintenance on that house is increasing exponentially. So even with the low interest rate locked in, a lot of people are finding they can't afford the houses, so now they're having to sell them, and we're seeing listings shot through the roof. We just covered on the show, I think it was 2 weeks ago, the amount of listings in the state of Florida alone is greater than all the listings in the top 10 New England states,
in
the whole
Northeast.
quadrant of the Northeast
New
of the
England
United
and
States.
the Northeast into New York and Pennsylvania. And
that is an amazing stat. So I gave an example, and I do, and I own, full disclosure, I own property. I own property in Florida. I own rental property in Florida. And the property, and literally I have a realtor down there that sends me an update on my properties every month, right? And gave me market softening was how he kind of put it. I'm like, so read the example there, the listing price.
August 29th, 2023, listed at $317,860. Same home still on the market in May of this year, and the listing has dropped to $265,000.
That's about a 25% drop in the price of the house, right? And still not sold.
Yeah.
So I sent a statistic out to the team this morning. Actually, I don't know if you got that in time for the show, but it showed a chart where the price of housing long term versus mortgage rates long term. We go back. I think the chart goes back like 50 years, and mortgage rates are literally, the 30-year mortgage rate is within 25 basis points of its 50-year average at about 6.79%. That's a 50-year average of a 30-year mortgage. Housing is 90% above its 50-year average in pricing. And so I simply said one of these two has to adjust, right? Because if we had 1% mortgages, you could justify the price of the houses being up where they are. But if we don't, something has to correct, and everything reverts to the mean. Again, we just look at data and math. We don't speculate, but something is going to break. So either interest rates are going to drop aggressively or housing prices are going to drop aggressively. And again, Zillow, one of the industry barometers watching real estate, has forecasting a negative price watch nationwide for real estate. And I told you on this show, we're expecting 7 to 9% reduction nationwide in real estate prices over the next 12 to 18 months. Now, every place will be different, and don't think that means anything. If it's your home and you're staying in it for the next 7 or 10 years, don't worry about it, right? It's long-term shelter. But if this is something you have to sell, well, that puts you in a quandary. You have to decide, do I want to sell for less? And again, we have not had that capitulation where sellers have said, all right, I'm just going to drop the price to sell it. But that's probably coming, especially in markets that were really hot for a while, Texas, Arizona, Florida, et cetera.
That'll do it for this week, folks. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer. No charge, no obligation for our events, but you do need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Have a blessed and prosperous week. We'll talk to you soon.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.
David Brooks, Retire Smart and Smart Wealth are not affiliated with True Shares in any way, shape, or form and do not invest in their product, and we're not compensated for his appearance or the closing bell. However, Smart Wealth has the right to invest its clients in such products in a future date.